Welcome to RBC's Markets in Motion podcast, recorded August 20th, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The three big things you need to know. First, a better, longer-term earnings outlook and more resilient operating margin forecasts help explain the recent outperformance of mega-cap growth stocks and growth-oriented sectors. Second, small caps recently saw a brief mild outperformance pop on mounting Fed cut optimism, but we remain neutral on small caps given elevated valuations and below average consensus GDP expectations. Third, mixed vibes to end the summer make us question whether the sentiment recovery that's powered U.S. stocks may soon hit a speed bump. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1. A better, longer-term earnings outlook and more resilient operating margin forecasts have helped explain the recent outperformance of mega-cap growth stocks and growth-oriented sectors. Growth rates embedded in consensus S&P 500 EPS forecasts have moved up sharply for 2025, but we haven't seen the same kind of upward momentum for 2026 and 2027 growth rates, which have been stable in August. This suggests to us that while 2Q25 reporting season turned out better than anticipated for the S&P 500, that hasn't translated into a surge in optimism around 26 and 27 earnings, at least to the same degree. The forward earnings outlook does help to explain why the biggest market cap names have continued to lead, at least until this week. Consensus earnings growth forecasts for the Mag 7 for 2026 and 2027 have taken some hits since the start of the year, but remain above those of the rest of the S&P 500. When we look at the gap between Mag 7 and S&P x Mag 7 earnings growth rates, we find that 2026 is expected to show the narrowest Mag 7 advantage, before the gap widens again in Mag 7's favor in 27. We think the persistence of this earnings growth advantage has helped power the outperformance of the biggest market cap names in August, especially since the 2026-2027 earnings growth forecast generally hasn't seen a major upgrade yet for the S&P. Meanwhile, all economy sectors, energy, materials, and industrials, along with healthcare, which like industrials and materials is impacted by tariffs, have seen margin forecasts come down a bit recently for both 2Q and 3Q of 2025. Tech is the only sector that's seen operating margin forecasts move up recently for both time periods. Comm services has seen some pressure for 2Q25, but an improvement for 3Q25. The greater margin resiliency of growth sectors relative to the value or old economy sectors also helps to explain their outperformance of late in our view. Moving on to takeaway number 2. Small caps saw a brief mild outperformance pop on mounting Fed cut optimism recently, but we remain neutral given elevated valuations and below average consensus GDP expectations. On a related note, consensus net income forecasts are still anticipating small caps will see faster net income growth than S&P 500 or Mag 7 in 2026. We think last week's brief small cap outperformance pop relative to large caps, which took the RTY-SPX relative ratio up to the high end of its post-Liberation Day range at midweek, had more to do with a ramping up of Fed cut expectations than the earnings outlook, but earnings dynamics may be a data point the small cap bulls turn their attention to in coming weeks. We remain neutral on small relative to large on a 6 to 12 month view. Near term, the earnings outlook, at least on paper, and deep net short positions per CFTC's latest data could keep this trade going short term if expectations for Fed cuts continue to grow. But our valuation work suggests there may not be too much runway here, as the Russell 2000 PE is already above average at 16.3 times, and the small-large relative valuation case has broken down on some calculations. Most importantly, small caps tend to need an outright recession or a very hot economy, think ramping ISM, accelerating jobs growth, above average GDP, to see sustainable outperformance trends, conditions that are simply lacking at the moment. Moving on to takeaway number 3. Mixed vibes to end the summer make us question whether the sentiment recovery that's powered U.S. equities may soon hit a speed bump. For institutional investors, overall positioning in U.S. equity futures got a bit more elevated after last week's update, but remains below peak levels. On some calculations, NASDAQ 100 futures positioning is starting to look quite stretched. For retail investors, net bullishness on the AAII survey has deteriorated sharply in August. While this is a bullish longer-term signal for the S&P 500, this deterioration is reminiscent of the move lower seen in this survey back in 1Q25. For small businesses, optimism in the NFIB survey has moved up slightly, but so has uncertainty. Views on the economy, employment, and CapEx did improve in the latest update, but the latter two remained quite weak. And for consumers, sentiment in the UMich survey fell slightly in the August preliminary reading. We watched this survey closely as it's done a decent job of tracking year-over-year S&P 500 and Russell 2000 performance since COVID, highlighting the importance of the vibes to equity prices. Interestingly, a deterioration was seen for all three of the major income brackets on overall sentiment. Wrapping up with our bottom line on the broader U.S. equity market, we are still nervous about the fall. We continue to think the summer rally in the S&P 500 has generally made sense from a sentiment perspective, but is also starting to run out of room from that angle. Meanwhile, our valuation modeling, which projects a year-end PE for the S&P 500 based on inflation and interest rate assumptions and data back to 1962, also suggests that current pricing in the S&P 500 reflects a far more benign inflation and interest rate environment than the one anticipated by the economics community at large. We continue to feel neutral, though not bearish, on U.S. equities. The earnings dynamics that have supported the recent rise in the S&P 500 have nevertheless exacerbated some risks, as forward PEs are close to recent peaks for the S&P 500 on a market cap weighted basis, an equal weighted measure of the top 10 market cap names in this index, and the NASDAQ 100. Mindful of this valuation pressure, along with the tendency of September and October to be tough months for the S&P 500 performance in recent years, and the sudden deterioration in AAII net bullishness, we do remain on guard for choppy conditions in the balance of the year. In terms of the broader macro, S&P 500 company commentary in 2Q25 reporting season has also kept us in the camp that the real test from tariffs from a U.S. corporate profitability, inflation cost perspective, and demand perspective is coming up in 3Q and 4Q. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.